just also keep that in mind. Um, so again, sorry that we got off topic a little bit, but today's session is going to be a little shorter anyway because we're basically just going over setting up and going into the Nasdaq every morning, and how to set up the charts and how do we find the draws on liquidity, and just what are we basically doing. This is it's a short lecture, but it's an important one. And I think a lot of people struggle with this, and if you can kind of come in to the markets and understand where all these levels are, I think it'll really, really help you. Okay. So let's kind of just put replay on. Let's just go back to here. Okay. So if I'm here, and I'm coming into this day, and again, you're not doing this every day. Yeah, later on in the session, later on in the session. I think, Lightheart, I think, Jeff, I think I did post the ninja video the other day. That's what I didn't post the video. That was the other thing that you sent. Yeah. Yeah, we'll look at trades after, Avi. I just want to kind of go through this. So, you know, basically what I do to get ready for the day and find key areas. Okay, so let's actually start a little higher. So typically, I don't really go to the monthly. I mean, I'm not swing trading. The monthly is just, it's absolutely meaningless. So I'm always going to the weekly first. I just want to know where the fair value gaps are. That's it. I want to have a little bit of a bias. I want to know where the highs and lows of the previous week are. I want to know if that previous week is an expansion. Other than that, I'm not really marking up the chart because I'm going to do it on the lower time frame charts. These are not draws on liquidity here, even though the weekly highs and weekly lows are draws on liquidity. We're going to see those levels anyway, okay, when we go down to the lower charts. So, on a Sunday night, I just make sure I understand where I am in a weekly, knowing we have fair value gaps here. Looking at, actually, this isn't a weekly. This one's a weekly. Just kind of looking at this fair value gaps and understanding, where they are. Um, and then kind of going down to a daily and, seeing where those fair value gaps are, and, are we on the opposite side of an inverse, and just kind of checking that stuff out. And again, I don't mark out previous days high lows and weekly high lows, because when we go onto the 4-hour chart, the only thing I care about is pivot highs and lows. That's it. Doesn't matter if it's a daily, if it's a weekly, if it's a monthly. To me, a 4-hour, or in this time frame, a pivot high or low is a pivot high or low. That's it. That's all I care about. And when I mark up my 4-hour chart, and this is where I start with, I don't care about what's a weekly and what's a daily, because everything that I'm going to mark up is going to take care of all of that. So to me, there's no reason to mark your charts up with PDH and PDL and weekly, daily, weekly, previous week high and previous week low and all this other stuff. Because what happens is, at the end of the day, after you're done, you got so many freaking lines on your chart that it's just analysis by paralysis by analysis. Reverse that. Okay. So I like to take a clean 4-hour chart, and all I'm basically doing, okay, and I do this with the ES also, because the ES, this is how I look at SMTs when we do this. So I very simply take a blue pivot line and I just mark out all my highs and lows. Okay, I start here, and basically, we broke this one right here. So whenever we break it, okay, I always go and make it a dash. So to me, that's a broken level. The reason why I do it is not because I'm looking for a break retest trade or anything like that. The reason why I'm doing it is because I have the same level marked on the ES. So if that way I have a good visual that one broke and the other one didn't. So that way I start understanding and getting a visual of SMT. That's it. Once they both break, I'll just erase it and just get it off my chart. I don't want it on my chart anymore because it's meaningless to me. Okay. Because anything below that I'm worried about is going to be these lows right here. Okay. And I mark up all my lows, and I'm very careful about it because I want to make sure I cover everything. Like for instance, this is a low also. Okay. Remember, any swing high or low is going to be a 3-candle formation with the middle candle's lower high lower than the two sides. This is a swing low. And you want to mark all of these swing lows. Okay. This is a swing low. And again, I'm just marking up charts. I'm not creating a bias. Okay. This is a swing low. Okay. But I also have these other swing lows right here. These all still qualify. So here I am marking up charts, right? Marking up. And then I have the bottom of this. This was this was probably a big move somehow. So I don't need to mark up. That's not really a swing low. So I'm not going to mark that. And then obviously I go to the top side and I'm gonna mark my swing high there. And this is a swing high also, right? And I'm gonna mark this right here. All right, and that's good. And obviously all these levels down here I would have already had marked from when we were in these levels, but let's assume that these are marked and we haven't really gotten to this level yet, so it's no big deal. Okay, so then I start to understand. Oh, was CPI day? Okay, that makes sense. That makes sense. So that's actually a good low because that's kind of like we can say a data low. Okay, now. So when I look at this chart and have everything marked up, okay, I obviously need to look to the left of everything and see also. So that's where the daily and the weekly time frames are going to come in. And obviously we're at all-time highs here, pretty much. So there's really nothing to mark, okay? And I believe this was an all-time high, I think. Let me put this on days, weeks. Yes. Okay. So now I kind of have an understanding. Okay, so that's the first thing I do. Highs and lows. Very simple. Okay. And then what I'll kind of do is I'll kind of look at the highs and lows. What does it represent? So to me, we have a dealing range right here, high to low. We broke the top. Okay. So what does that mean? We broke it external, and now we're going to come back into some type of internal. Okay. But this area, if the trend is still, bullish, should not be hit. It's not the draw on liquidity yet. Okay. But we don't know how far price is going to go above the external level. Okay. And that's why we don't like trading too much from external to internal. But we can do it intraday when the external to internal is on the 4 hour and we're trading on 5 minute, 3 minute, 2 minute charts. Okay, because we're so far down the totem pole time wise that trading a longer term external to internal is totally fine. What we want to try to avoid is on this time frame that we hit the external, and this will be external on the daily too and the weekly, probably. Let's see. Yeah, daily. Yeah, so the daily was right here. We have to kind of, we don't really want to trade that. Okay, but internally, we just want to know that we're either going from internal to external or external to internal. It's really only thing that we're worried about. So if I'm coming here, I got everything marked, and the first thing I say to myself, okay, we broke long-term external, okay, which basically means that all the targets I was using on the long side, the buy side of the curve here, has now been met. I don't have any more targets. Plus, we're at all-time highs. Now, if we had, we weren't at all-time highs and we had levels up here, to the left, then obviously we can continue to target these levels up here. Okay, but that's not the case. This is all-time highs. So now I'm kind of seeing, do I have anything to the left? Now, when I do have ones to the left, and it would kind of look like, let's see, it would kind of look like this. Okay, let's pretend it's that. So we hit external. Now we want to see to the left. So what's to the left? I have that pivot high. I've got that, and I've got that. So these are targets, and I'm going to make these a different color so we don't get confused. So those are targets. Why are they targets? Because we're still in a buy model. We reached external liquidity, and the draws on liquidity are always going to be these pivot highs. Okay. Now, when do we stop being bullish? We stop being bullish when we cross this one, because that's the last pivot high that we have to work with. Then we would look for another external to internal move. Okay. But in this case, we're at all-time highs. So there's nothing to the left, which makes it a little bit more difficult because we really can't have that much of a bullish bias at all-time highs. I know that sounds weird, okay? But in order to get into a trade and to frame a trade, you not only need an entry, you not only need to be delivering from something, you need to have a target. I always use the get in your car example. Nobody gets in their car ever without having a destination, unless you had a fight with your spouse. My dad used to do that all the time with mom. I never could figure out why he did that. Why just not go to the other side of the house? But anyway, you know what I'm saying. We don't leave the house. Oh, I got a funny story about that, John, when my kids were young about that. Um, sitting in a CVS pharmacy line for half an hour and just being the happiest guy in the world that I wasn't home. But anyway, in a trade, you need to have a target. When you're at all-time highs, there's no target. It's very difficult to trade. And once you reach that last pivot high to the left, we now run out of targets. So now we have one or two choices. We need to trade from external to internal, which is not easy, or we need to wait for external to move back into internal and then look to trade internal to external again when we're at all-time highs. Now, this is an all-time high. If price comes lower and takes out this liquidity and starts moving higher, we now have targets, right? We now have upside targets. But right now, going long, we do have targets here, but above that, we have no target. So when we got here, there's no target. And if you're just trading a pattern or an entry model, then you're a pattern trader. And we don't want to be pattern traders. Okay. So there's no reason to get into a trade without a target. Okay. Very simple. Okay. So now I have all these marked. So now I understand where liquidity is. And, the first thing I like to look at when I do draw these is, do I have a lot of lows or highs bunched together? Because you know how much I love those. Those are huge draws on liquidity. So right here. I say to myself, this is a very high draw on liquidity. Is it going to get there within the next couple of days? I don't know. But then I have to say to myself, what needs to happen for us to get there? Well, I need to inverse the fair value gap. That's our model. Okay. So I'm looking at the 4-hour chart and I do see a fair value gap right here. Okay. But I don't like this fair value gap. Why? Who can tell me why I don't like this fair value gap? Gilberto, I know you know.
That wick went past it. So
Which wick?
um
This one?
that yeah, that those you're
No,
kind of looking to.
that's
No?
not it. Nope. That's not what I'm looking for. Long wicks, yes, long wicks on the left. Okay, so everybody's talking about this candle right here, right? Yeah, I don't like that. Okay, so what do I do? Do I accept it? Do I accept it, or do I do something else? Okay, to save time, to do something else is I'm going to look at other time frames. So I'm going to go down to a 2-hour, same problem. I probably have to go higher. So let's go to a 6-hour. Okay, 6-hour, I have two fair value gaps. 8-hour, I have the wick again. So the 6-hour is the best. Even though it's got two, I could still play this lower fair value gap. Okay. So then I say to myself, if these get taken out as well, and we inverse this fair value gap, then I can target here. And if I inverse that fair value gap, I can target here. If I bounce from these fair value gaps, I can turn around and target these. If I bounce from here, I can then target highs left on the way down. Because I don't like fair value gaps with big wicks. And I'll show you why. And I believe this worked out. I don't like it because wicks are retail traders. The bodies are institutional smart money. If you look at a candle, if you look at a volume profile of a candle, okay, let's take here. Let's take this. Here, let's just take this candle, this 4-hour candle. What's this 4-hour candle? Thursday the 14th at 6 o'clock. So we're going to take this candle. This is the body of the candle right here. What did I do here? Oh, I have to make it like that. That's the body of the candle. Okay, let's save it. Let's go to a 5-minute chart. Okay, so we have, I think it was 6 to 10. Okay. So if I do a volume profile from the start of it to the end of it, most of the volume is right around the body. Actually, I think I went too far. I think it's 5. Yeah. No. Yeah, I think I got the wrong set. Anyway, what I'm trying to get at is that the highest volume of this candle, or most candles, are going to be within the body, not the wicks. So when a fair value gap has a big wick, I don't like that because to me, this is all retail traders. I don't like this. So if I inverse this fair value gap with the wick, I don't like it. So I'll go up a time frame to search for a fair value gap. Look how much cleaner this is, right? It goes, there's barely any wicks. This is a real fair value gap. Yes, 100%, Pavel. Bodies tell the story, wicks do the damage. That's why when we see these big wicks, this is just manipulation and retail traders getting caught. It's not just retail traders, it's dumb money. Everybody says it's retail traders. There's a lot of dumb institutional money out there too. Don't kid yourself. It's smart money and dumb money. Retail traders are not always dumb money. There's just small money, but they're not all dumb. Traders who get on the wrong side. So that's why the bodies are important. So now I have a cleaner fair value gap. I like that much better. Okay, so I'm going to mark out all these gaps of importance. And if they're on different time frames, I'll just mark them that way. You know, this 6 hour has been perfect on all three of these. Perfect. That's why you have to kind of play with these time frames. When I go to the 4 hour, okay, I'm going to be able to get all these highs and lows, but the fair value gaps, I want to make sure I'm right on. And the 6 hour here, from here to here, has had the best fair value gaps, cleanest. So I'm going to have all of those marked now. So now I have all of those marked. So that's my higher time frame. Okay. Now, why do we do that? Because what are our biggest draws on liquidity? we like to trade from external highs to fair value gaps. So if and internal to external. So if we're trading internal to external, internal to external, internal to external, or external back to internal, if all we're going to do that, then this is the most important information that we can have. Highs and lows and fair value gaps. They're all draws on liquidity and places we can act from. So now I have all the spots that I know I can act from. Okay. Then I'm going to go down to a lower time frame. I really don't need to go down to an hour, but I could. I just want to kind of see if I can find, different situations. And here's a perfect example why you need to look at higher time frames. If I just looked at the 1 hour here, I see a really nice fair value gap right here. And I'll make this darker. Okay, but the higher time frame is lower. And we have a nice order block right here before the move higher. So this can easily be support. If we break this fair value gap, this 1 hour, we could definitely find support in this order block because the higher time frame fair value gap is all of this, not just that. And that's why it's so important to check your higher time frames. Okay. But when I come in the morning, I also want to make sure that my 1 hours are marked. Now, the way I do that is I have the nephew Sam indicator, so that's just going to plot the fair value gaps on there anyway. Okay, and I want to see what we're delivering from, and then like a day like here, I want to see, well, what's the situation? So on a day like this, I have the highs and the lows kind of marked out, but there's really no bias. And now, and also the kill zones, London highs and lows, Asia highs and lows. I want to know where those are also. Mark them out. When we come into New York, what is still open? What if Asia highs and lows are still open? What if London highs and lows are still open? What is still open? Okay. What did Asia and London do? Did it accumulate? Did it manipulate? Did it distribute? Right? Because in New York, if we're playing AMD, accumulation, manipulation, distribution, we need to know what London did. So if I'm coming in here, it's all accumulation. So what happens after accumulation? Manipulation. So now coming into New York, I'd be looking for manipulation. So let's kind of see how now we get a fair value gap. Now, is this a good fair value gap to play? No, because it's right in the middle of these lows and these highs. Okay, and now I have London highs right here. And this high right here is 1 o'clock. And this right here is yesterday's afternoon's high. So when I go down to the hourly chart, I want to mark these out also. Okay, so let's forward the chart. Okay, now we have a break of a level here. Okay, into the fair value gap. Okay, and it's 10 o'clock in the morning. So now what we want to see is we want to see displacement, which we didn't get, and that's why we got a rally or a bounce. And Friday, I think, was a pretty dead day, if I'm not mistaken. Okay. Now, what's the bias? Okay, here we're in the afternoon. Actually, this is nighttime already. This is Asia. Okay, so now we already took out this low. But we're not really bearish because we're still within a 6-hour fair value gap. So we can't be bearish. But we can't be bullish because we didn't inverse a bearish fair value gap to the upside. So it's a neutral bias. But I have my levels pointed out. And then coming in here, I now have a new level to trade. I have the Asia high. Okay, now price starts closing lower, and now we have a fair value gap to the downside. Okay, but we're still in this big fair value gap here. Okay, and this is Monday the 18th. coming into New York. We're kind of consolidating. Now, if we're going to go lower, we need to see a manipulation. So I'm going to obviously mark out these highs. And as you can see, I'm on the 1 hour chart. Trade the 1 hour chart. Execute on the 1 minute. Because this is kind of giving us an idea. Okay, now we have a move up. That looks like a manipulation to me. We manipulated up into a fair value gap. So now I'd go down to my lower time frames, my 5 minute, my 3 minute, my 2 minute, and see what's going on. Okay, well, this is actually the end of the day here. So we can't do that. So let's kind of fast forward it a little bit. We did pull away from there. Now we're in Asia. All right, so now we're coming in. Oh, I didn't mean to do that. So now we came into New York. And if I'm coming into New York, what am I thinking about? We accumulated, we manipulated. What's the next logical thing to happen? We're going to distribute. Even though we're in this big fair value gap, the order flow is bearish. And this manipulation into this fair value gap, when we start to see buy side liquidity manipulated constantly, even this level right here, this was a manipulation above these highs into this fair value gap. We know that the bias is now lower, okay? Especially at least to this pivot low, which now becomes a new target. And obviously, when the markets opened, we hit that target and dropped right below. So now this is a broken level. So we take that off. Okay, now we're coming pretty darn close to these levels. So now we know this is the draw on liquidity. We had bearish movement up here, and now we know this is the draw on liquidity. Okay, so on Tuesday, we can spend the day on the shorter time frames looking for moves into these levels. Boom, like butter. Like butter. And look at all the time you had to buy. From the close of this candle, we had a rally of 60 points. And for all you broken support becomes resistance guys, that's a basic concept, right? That's a confluence concept. Okay, so now we have a bias. Okay, we continue, but now all of these liquidity levels have been taken out, right? So they're gone. Okay, now we want to see, is price displacing below, which it is, through these levels, which means, are we going to start attacking these levels right here and these levels down here? And we have fair value here. So when you have a level below you and you have an untapped fair value gap, these are all draws on liquidity. It's not going to stop here, reverse, and go higher. It's going to attack these levels. It's going to keep attacking. So this is Tuesday, 11 o'clock. We create a fair value gap. We attack that low. We attack that fair value gap, just like we expected. Now it's the afternoon. Okay, now we're coming in, trading in Asia. Look what happens here, right? Look what happens here. If you're coming into New York session on this day, you're drooling because you see what just happened. We have a major spot of liquidity. We have fair value right below, and we stopped right before. Now all you need is a reason to sell. We have a 1 hour fair value gap right here. Okay, this is 7 in the morning. It's still before New York, so we got to fast forward a little bit. Boom. Like butter. Not only this one, but these two right here as well. Now, how do you know not to take a long and a reversal at these levels? Well, we have buy models and price action that we need to see first, right? And everybody knows what that is. We have to deliver from a higher time frame fair value gap. Okay, we have to have a fair value gap into that area. We have to have SMT with ES, Kraken correlation. Okay, and we have to have, excuse me, and we have to have an inverse of that fair value gap from the delivery with momentum. If we don't see it, then smart money is telling us not to enter and go long. That keeps us out of trades. That keeps us from guessing. Okay, now we just broke this low right here. If we don't displace behind this low, this is a good spot to possibly bounce because the next low is so much further lower. It would be logical for this to bounce considering there's only a little fair value down here it might tap into. So I'd be looking for something to maybe take a long or a bounce here. Maybe if it does. Well, look what happened. Look at that bounce. 250 points into that fair value gap. Why? Because we go from external back to internal. That's an external to an internal trade. I bet you there was a really good inverse fair value gap at that level, attacking that right after we hit those lows. Okay. So now we come in and, we continue to mark our charts up. We obviously have this high right here. Okay. We have this fair value gap right here, but that's pretty high up. This is the main fair value gap we're taking a look at. Okay. This is coming into the afternoon of trading. So obviously we're not trading during this time. Asia comes, kind of consolidating. What time is that? All right. So the New York opens. And now we have these highs right here, Asia and London. So that's a draw on liquidity. Okay, we have these lows right here, which are the lows from yesterday. So they're a draw on liquidity. And let's see where price wants to go. Nowhere. Consolidated day. Left liquidity. Created more liquidity. This is now a pivot low right there, right? This is now a high. All of a sudden, we got two highs pretty close to each other. But if I'm coming in here, I got draws on liquidity lower and higher. That's a conflict. You see how on some of these other examples on the way down, we were very clear on the draw on liquidity. Here, we're not so clear. We have no fair value gaps here. There's no displacement. Price can easily take these out first or these out. I don't know. So for here, it's tough. So then we finally take out this level right here. We don't need to take out this level. By taking out this level and manipulating, okay, now what's the draw on liquidity? It's now Asia highs right here, which we draw. So now we know the draws on liquidity here, here, and here. This is still going to be a draw, but we may bounce first. And boom, we take out this first liquidity as expected. That's 50, 60 points. Profits taken, runners in. Boom. What happens later? We take out all this other liquidity as expected. Right? We could tell the draws on liquidity before they happen. Now we have a fair value gap, and we're going to kind of, screw around for a while. Asia comes. We're still in this fair value gap. Now we have a pivot high here. So, and a pivot low here, right? So what are the draws on liquidity? It's kind of tough. We're going internal to external. But if you look at the 4-hour, we're kind of in the right at this fair value gap here. So it's hard. We're in a bearish fair value gap right here, supported by a bullish, rejected by a bearish on the 4-hour on the higher time frame. So here it's a conflicting bias. What do we do with a conflicting bias? We don't do anything. We just wait. Price breaks lower. What's it going to do? Is it going to displace lower? It's also filling these fair value gaps. But since this is almost filled, are we going to go internal to external? Well, I would like to see an inverse of this fair value gap and attack those highs if we don't displace below. And by the way, we just created another key point to watch. But this is already broken. Okay, we're just kind of screwing around, and New York opens right here, and now we inverse this fair value gap. Now we do have fair value here, okay, but we have another high right here. So the draw on liquidity should be higher. Okay, we still have London lows here. It's not an A plus situation, but it should still be higher. Takes out one, right? And at this point, you know your draw on liquidity is up here. I mean, we're up here. Why not take it? Boom. Right? Easy. All right, this is the end of the day. Okay, this looks like was this the Nvidia candle? This might have been the Nvidia candle. So now we have that data high on the Nvidia news, and that's still a data high. And oops, data high. Oop. Okay, so now that's the line in the sand, short term, the Nvidia highs and lows. All right. Now, obviously, I'd go down to a shorter term chart once we come into New York. We have a little bit of a fair value gap here. That's nothing. We did take out internal liquidity right here. So that could give an indication we're going to attack the highs first. Then we come into New York. Okay. And we come into New York and we displace in London. And coming into New York, what do? We come into a fair value gap, take internal liquidity. I bet you there was a nice 1 minute signal here. And we take out the data highs, just like we expected. After this was taken out, we knew we weren't going to attack these yet. So it made sense. If we don't go lower, you have to go higher. If you can't go higher, you have to go lower. Okay, now this is all taken out, this data high. Okay, now we have some extra spots here. Now we have a low right here, a new low. And these are all pivot lows. These are all our high draws on liquidity. We now have London lows right there from that day. We have past Asian lows. Don't forget to keep these marked. You want these marks for days ahead. Displace is a fair value gap. When you make a fair value gap, you displace. Very simple. A fair value gap is created away from price, away from the level that you're looking at. So if you come into a key level and there's a fair value gap out of that level, that's displacement. We want to see displacement because that's smart money. That's big money taking action. Okay. So now we crossed above this level. Now, are we going to keep going higher? I don't know. You know, we need to figure out price action. The price comes into Asia. Price comes into London. Now, usually there's no fair value gaps here. So I would go down to a shorter term chart to kind of take a look at what the overnight action was. Okay. And the first thing I see, and I remember this, is that we inverse this 15-minute fair value gap in London. So what does that mean? If this was a 1 minute chart and we were playing a CPI number and we broke above the highs and then we had a series of inverse fair value gaps right here. I would never take an inverse fair value gap in Asia. So this meant nothing. And as you can see, this inverse of this fair value gap had momentum. This didn't. And that's why you don't trade Asia. So that's why this was more important. Okay. This was also coming into discount where this was in premium. But once we cross this, now I know that the draw on liquidity is lower. Okay, it's likely these data lows because these are one of the highest draws on liquidity, which means that we should butter through all of these because this is going to be the draw on liquidity because this is how we play data high, data lows. Let's fast forward. But now we got to come into New York. Not in New York yet. And we need to see a kind of a manipulation in New York, which would be right above here. That's what we would look for. Boom. Price moves above there. Exactly what we wanted to do, right? Because the bias is lower. So if the bias is lower and the draw is lower, we want to see price go higher first and take out liquidity. Then we want to enter a trade for price to go back lower. Boom. Like butter. We took out manipulation, we took out this level, we took out this level, we took out this level, and we took out data lows. Okay. But after we take out data lows, we still have these two levels here, and there were equal lows here. So the bias is still to take out these lows and continue higher. So using the 1 hour time frame, you're going to kind of, see what's happening. So this is 10 o'clock and price has a bounce, which is great. But then obviously it takes out this low. Then it bounces, but it still leaves this low. And this is the true draw on liquidity, this low right here. Because not only do you have a low there, you have untapped fair value right below it that's left from this fair value gap. So this is 1 o'clock in the afternoon. So time is obviously, becoming an issue. We start rallying a little bit after the close, come into Asia, pull back. Okay. Broke this level right here, left equal lows right here. Okay. But now this is an area, Asian high, that we're taking a look at. So if we take out this low, it makes sense for us now to take out this high. We don't have to, but it just makes sense. Nope, didn't. This fair value got presented fair value. And when we came into New York, we broke London high, manipulated there. That was the manipulation. And then boom. And then today we come in, obviously, same situation. But we had news overnight. So price had already broken through these levels overnight. This is, yeah. So let's fast forward. Now we have these levels right down here that we're still concerned with. These London lows and these lows right here. These are the targets on liquidity. Why do we think that? Especially after this 1 hour here is inversed. For sure, the draw on liquidity is lower. Let's see what happens. We come in at 6 o'clock. Yeah, the problem is everything dropped in London, but the draws on liquidity are hitting. And as you can see, we drew. As soon as we drew the last line of liquidity, what happened? We had a huge bounce. That's the bounce you trade. Where do you trade? You're going to target fair value because what does the market do? It goes from external to internal, and then you had a move away from it. So as you can see, we just traded the past 2 weeks using only highs and lows, fair value gaps, and session liquidity. I didn't even go down anything lower than a 1 hour, really. Okay. And if you go down to the lower time frames, that's where you're going to find your actual executions. And we all know that this is what we struggle with, right? The executions are easy because we all know what a light bulb execution is. We all know what the checklist is. We've done it 100 times. We do it a lot of times when we shouldn't. We know it really well. It's this that people struggle with. Where is price going? What does price need to do to show me that it's bearish, bullish? And by using highs and lows, fair value gaps, Okay, and manipulation is important. You need to manipulate some type of internal liquidity, and that happens everywhere. Before we went down here and manipulated. Before we went down here, we took out London highs. We manipulated. Before this candle, we took out these previous highs. And these are hourly candles. So these are a lot of data here. That's why when you look at the hourly, things just make so much more sense. You can see manipulation better. Okay, just for instance, look at this candle right here. This candle right here takes out this low, and that low, and closes way above. Is it any coincidence that we had a rally after? If you can find these candles on the 1 hour chart, it's going to really help you with your bias. These candles that grab liquidity, that take out multiple levels. Here's another one. This candle right here. What did this candle do? Let me just, what did this candle right here do? It took out all these lows of these 1 hours. Accumulation. The wick is manipulation. Remember, retail traders getting trapped. Manipulation, right? Distribution. Where are we distributing to? Highs up here, Asia highs, hourly highs. Obviously, we didn't get to external liquidity because we wanted to come down further before we did. But eventually, we came down here and hit external liquidity up here. We always do. When you get these big fair value gaps, a lot of times it'll come in, rally, come back for a second time, take that liquidity, and then go for it. So that's how I trade the Nasdaq. That's how I set up and look at everything every day. It's all done from the higher time frame. Everything, the bias and everything. Once I have my bias, I have all these levels are all marked on my 1 minute and my 2 minutes because I save everything to other layouts. So when I open my 1 minute, these levels are all there. On my 1 minute, I keep 15-minute fair value gaps. On my 5 minute, I keep hourly. On my 15-minute, I keep 4 hour. So I always have the higher time frame fair value gaps on my computer. Okay. I'm not interested in 5 minute fair value gaps or 2 minute fair value gaps, only in execution. For a bias, I want 15-minute, but really 1 hour fair value gaps. Yes, it is, John. If the trend is in your favor, 15-minute fair value gaps are perfectly fine on Nasdaq. Anything else, currencies, I would keep it an hour or above. But NQES 100%. 15-minute is very good. When things are really trending and you want to get crazy, it's not really consistent with my model. But 5 minutes can also be used also. Data high, data low is just a big wick, Steve. A big candle that leaves a wick on either side from a news announcement. Whether it's a news announcement that we're expecting. In this case that we were talking about, it was NVIDIA earnings. It just leaves it's a big move in the market that leaves a big wick on either side. Those wicks on either side are called data highs and lows. It could be an earnings announcement. It could be a Trump announcement. It could be anything. Could be anything. Does that make sense? Okay. Gotcha. Gotcha. All right. I'm going to open this up to questions. I kind of went a little, actually, I didn't go that long. I think we chatted a lot in the beginning. Um, and Roger, I saw your thing. Just do the due diligence for me, and if you can, and just kind of figure it out if they accept US, and I'll take it from there. I just, I'll take a look, but just gather the information for me if you can. So I'll take questions now. If you have a question, just type question in the box. I'll call on you, take the mic, and we can go from there. Pavel, you could still ask the question. The question is for you.
Okay, so if I can ask, when you're placing your targets and there's a high time frame fair value gap, do you consider it as a target, the potentially
Yeah,
bouncing?
fair value is a target also. It's don't forget liquidity highs and lows and fair value gaps. They're draws on liquidity and they're draws away. So we can draw to them and we can draw away from them.
Okay, good. Thanks.
Okay. Steve, can I explain how retail traders listen, I don't like to use the word retail traders. It's just it's dumb money. It's traders that get caught. These big wicks are created by traders getting caught and manipulated. That's why they're wicks. Most of the volume in the institution is going to happen within a candle. But when you have a big wick in one direction, that means a hard reversal from each direction, which means that somebody's getting caught on the wrong side. That's usually what it means. So big wicks are good draws on liquidity afterwards. They can be used to identify manipulation and a reversal, but then eventually they're good draws on liquidity. All big wicks of any candle always get taken out eventually. Do I take into account all zones? 950, 10. I don't know what that means. What is 950, 1050? Are you talking about macro times? I don't believe in macro times. I think that's all BS. No, yeah, I think macros are BS because ICT, first of all, it's an ICT thing. Just keep that in mind. And does anybody understand? Does anybody know the reasoning behind a macro? Does anybody understand the reasoning? Or do we just know it's a macro? No. Okay. It's really simple. Why is it 950 to 1010? Because it revolves around the close of the 1 hour candle. And if you see on this thing, when we closed, it manipulated above the 1 hour candle and then went lower. So it all revolves around the 1 hour close candle. But price does not always manipulate the 1 hour candle, the high and low, right away. So macros can be either an accumulation, a manipulation, or a distribution. Big deal. I'm going to recognize that anyway. I just, listen, to me, it's just another concept that you just don't need. Understand the drawn liquidity. Okay. If macros are so special, they're going to show their hands, the price action, which you're going to see anyway. So I wouldn't, I'm not a big macro fan. Just, you know, some people swear by it. I see no data to provide. And not only does every hourly start, but at 10 o'clock, the 4 hour candle also closes and starts. That's why the 950 to 1010, that's the only macro I believe in a little bit. So if I'm bullish and I want to enter a trade, I'm waiting for the 10 o'clock candle to open because if I'm bullish, it has to dip below that 10 o'clock price before it goes higher because it has to make a wick. Has to make a wick. Here, this candle right here, whatever candle it was, it opened and closed here, but when it opened, it went higher first. So if I'm bearish right here, I don't want to be bearish until this candle opens because I want to be able to short above the opening price of this candle. That's the definition of a macro. But to me, the only one that really matters is the 950 to 1010. The rest of them is just noise. Abhi, when price delivers from a higher time frame fair value gap, what if the wick goes past that higher time frame? Yeah, as long as the body doesn't close below or above a fair value gap, it's good. As a matter of fact, when price comes into a fair value gap and rejects, you want to see that. That's what you want to see. You want to see rejection from that fair value gap. So a big wick from that fair value gap, even if it goes below, is totally fine. Pavel, I don't use heat map. I don't know if anybody else does. To me, it's not needed when you know these concepts. Look how simple, look how simple what we do here. You could take any chart. You can go to barchart.com and do this. So if we can do this without any fancy indicators or any algos or anything else, just by understanding what the draws on liquidity are and drawing highs and lows and fair value gaps and knowing the relationship, all this other stuff is just noise. Yeah, fair value is this is a fair value gap right here. It means price moved so fast that very few transactions were able to exist in this area. It's the opposite of a point of control. Point of control is a lot of transactions occurred. A fair value gap, very few. So the theory is that when price comes back into it, the buyers that missed out there will rebalance and fill their orders, which will take price higher. So price is efficient. It always comes back to fill their orders before they go higher. Now, if when price comes back into this fair value gap and those orders are not there anymore, price is then going to drop and close below. And in that case, we have an inverse fair value gap, which we had right here. See right here, it inversed. And when it inverses now, we still go internal to external, but instead of this internal to external, we go internal to external to the lower side. So we're only using highs and lows and fair value gaps, and that's it. So if you're paying for any fancy indicators or tools or courses or anything besides what we're doing here, it's not necessary. Other ways to trade the market? Yeah. I bet you could take a heat map and come up with a strategy. I go to YouTube, I could find 100 guys trading different strategies, some the same, you know. There are other guys who kind of trade similar to what I do. But I will tell you this, whatever strategy you use or whatever's part of your trading plan, the one thing that has been consistent across the board with traders who make money is those traders trade less trades and spend less time on the charts than traders who trade more and spend more time on charts. And that's a fact. Extension of previous question. What if body closes past the higher time frame fair? That's good. Yeah. What's still valid? Fair value gaps are invalidated. First of all, it's never invalidated, Avi.
Okay, no,
A
my point was when it delivers from that high time frame fair value gap, I want to know when is that high time frame fair value gap invalidated? Like it's like, okay,
Well,
now we cannot use it.
it's never invalidated. If it
Oh,
crosses above here, like this, like pretend here, this is a bullish long-term fair value gap. It's on a 4 hour. This is a good example, right? See how we defend
yeah,
this?
yeah,
It's valid to buy into as long as we don't close. Now, you see this bar right there that we close below?
yeah. That's the question. Yes.
Okay, now it becomes invalid to buy. But it now becomes valid to short. So it's still giving us information. So I don't like to use the word invalid because invalid means throw away and don't use. That's not the case here.
Oh,
All we're saying now is now this fair value gap, which before, and I'll change the color, was a bullish fair value gap that we can use to go long off of. When it closes below, it's now an inverse fair value gap, which we now use to short and go to external liquidity on the lower side.
that is when the candle closes, not the wick.
Has to close. It has to close, and the candle has
Candle
to
has.
close on the time frame you are looking at.
Yes. Okay, the candle has to close, but the wick,
Yes,
if
a
there's just a
close.
wick going
Yes.
through, that's not. That's
No,
we can.
no, no. The wick is a fake out.
Wick is a fake
Told
high.
you,
Okay, got it.
wicks are manipulation.
Yeah, got
Here,
it.
here's a perfect example. Look at this price action right here. These candles right here. 1, 2, 3, 4, 5, 6, 7. 7 candles, right? Prices in a box, right?
Right.
Okay, but we can see something that most people can't. We can see manipulation. This candle, we can see how it manipulated all these relative equal lows and these lows right here. We can see that, right? We can see the manipulation. That's why we had such a move higher above. This is how we can generate information before other people have it, by looking at price action. Wicks tell the story. They do the damage. Okay, look at the damage this does. This is manipulation. And it closed near its high. That's why we look at the 1 hour charts, because this is going to give you a bias. And once this candle closes, I know with certainty of my firstborn, we're at least going to that, or at least going to this right here, this high. And you all know that because we all trade that way. When you manipulate to the downside, it means we're going to upside liquidity. And look at all the liquidity it took it out, except when we got to this fair value gap. This is where we had resistance. That's what fair value gap does originally. And look how price resisted that fair value gap and supported this fair value gap, and that's why we had sideways action. So actually, this is good to look at. I'm glad this just came up because we didn't go over this. When you have something like this, and this is good, because when you have something like this, you have a bearish fair value gap that's being respected, and you have a bullish fair value gap that's being respected. Now you may say that, oh, we're not trending, I can't trade. No, there's a 4 hour chart. That means you want to get you kind of treat this like a premium and discount, where you want to get find longs in this area and find shorts in this area until one of these fair value gaps gets disrespected. And this is how you also form a bias coming into a morning, because from the 22nd of August until the 28th, these 6 days, even though we were in consolidation, I bet you if you go back to your charts on a 1 minute chart, all the good trades down here and all the good shorts up here, and you have the confidence to do so because you can see the color and the fair value gaps here. You can see where you are. And that would give a bias of rotating conditions, where there's no real draw on liquidity in rotation. The only draws on liquidity are the little highs and lows that we make inside here. Like this took out this. This bar took out these two bars. These two bars took out these two bars, reversed. This bar took out this bar, then took out that bar, and then came in, and finally we broke out. Everything's going to chop around. But if you look for longs at the bottom of the range and shorts near the top of the range, that's how you make money in a sideways market. Pavel, did you develop the strategy? So I've been trading for almost a little over 28 years. So I've had a lot of experience in manipulation. So fast forward, I worked with volume profile since 2006. So I've been working with volume profile for a very long time. In 2019, I started adding these smart money concepts and these things to kind of really give me a better indication of price action that volume profile wasn't. And this isn't anything that I didn't know before, but what ICT did in smart money, it kind of packaged this to the point where it just made a little bit more sense, that you said, oh, I knew that, but this is how we can kind of use the candle. So after I started working with that, I pretty much focused on a lot of this. The only difference I would say is that in the beginning of my smart money tutelage, I was focusing more on order blocks, not fair value gaps. And I found those to be very, very subjective and inconsistent. I was making money with them, but my win loss rate was like 55, 60%. And sometimes it was lower, but the risk to reward on the trades were 5 to 1 or better. I didn't like it. I just found it very subjective. So, there are some guys on the internet and YouTube that I do follow, some smart guys. There's a lot of garbage out there, but I sift through a lot of stuff. You pick up a couple of things here. The inverse fair value gaps, I kind of knew, but I started using this as an entry model about a year and a half ago. Seeing somebody else kind of using it, I'm like, yeah, that makes sense. I'm using it anyway, but why don't I just use them as an entry model on a fractal time frame? So a lot of the stuff I knew, but I guess some of the guys that I've seen and met kind of put things together for me. But at the end of the day, you can find 10 traders and even people in this room, we all may be trading the same concepts. We're all going to have our little things that we notice. And there are things that I show you that I notice that come with experience. So some of it is proprietary that I've kind of come up with. A lot of it is kind of piecing together from what some other people do consistently. But like I said, there's many ways to skin a cat. But the one consistent thing that I keep telling you is, don't overtrade. Look for setups that fit your criteria, your model. You don't need to trade 4 or 5 different models, which I used to do, and just focus, and that's it. And get funded and make more money by getting more capital, not by taking more risk, and you'll see it play out pretty nicely. Yeah. Go ahead, Carl. Robert, go ahead.
So, since you've been refining the strategy over years and kind of taking bits and pieces and baking it all together,
Right.
should we just go ahead and call it Daveology? So we're in Daveology
Nah,
101.
you don't need to call it anything. There are so many guys who need to call things. It's not a brand. A lot of these techniques that I show you, you can find other people using these techniques. Obviously I put them together, maybe a little different. Maybe some confluences I use differently. Like for instance, using the initial balance for me is something that I've known for a while, but I just started incorporating it maybe 6 months ago, and it's been a huge help
Nice.
for day trading. And I'm going to do an initial balance webinar soon, maybe Thursday, but maybe next week. And but the way I use the initial balance is very different than the way it's taught. Because I see the things that helps me with it. I don't use it in the traditional sense. So that's where you can take something, and it's all screen time. It's all about just getting on the charts and taking a look at something and see how price reacts. And if you back test and you look enough, you'll start to see the same patterns over and over again, and you say, that's interesting to me. So that's how that comes apart. Listen, it's a lot of work, and the one thing that's great about trading is that this is a never-ending educational process. I still learn new things. Okay. But what I don't want to do is have multiple strategies. It has to fit inside what I do. Because when you start to kind of go outside your comfort zone and your strategies, that's when you kind of start to get lost. And that's not good. That's not good at all. You need to stay in your comfort zone. Everything that you add has to fit to your strategy like a Lego piece. It can't be a square peg in a round hole and make it fit. And it just has to be an add-on or some type of confluence. Um, Oops. Hold on one sec. I'm sorry, I'm not taking that, but I forgot to shut my phone off. Okay. I forgot my tone of thought. Robert, was that it, or did you have something else?
No, that was just a joke.
Okay.
Just a joke real quick.
Yeah.
Yeah, sorry
Yeah,
to
it's
do
a,
that.
it's a never it's a never-ending process. And you know, what we teach here, I'm trying to keep it simple because people who are starting out who are not profitable yet, I think it's really important to keep this simple. If it's not simple, then this is the problems that you've had with other courses and other mentors. They don't keep it simple, they keep it very subjective, and they don't show you what you need to show. So there are other things that I use as confluence, and sometimes I will take trades that I don't really post or advertise here because I don't want people to be doing things outside of what they should be doing. When we get to the swing trading, things will be very, very clean. There are a couple different models that I do use for swing trading. So the difference is there is you have more time to evaluate, where during the day you don't. You know, it happens very quickly. You got to be really quick. Okay, swing trading, we've got time. Yeah, simplicity is important, Steve. It has to be simple. And I'm glad you brought that up because that's the other common ground. See, it's funny because I've known a lot of great traders over the years. I speak to traders, I see traders, and I can honestly say that every single one of them is different. Their strategies, what they do, maybe there's some confluences, but there are two things that are exactly the same. They don't trade a lot. They only look for perfect setups, and everything what they do is simple. If you ask them what their strategy is, they'll tell you in a simple sentence or two, and that's it. And one guy once told me is that if you can't describe your strategy in a simple sentence or two, then it's too complicated. And if you asked a very experienced trader what your strategy is, your reaction should be, that's it? That's all you do? It should be shock that it's that simple. It should be so ridiculously simple that A, you don't believe it, and B, it kind of makes you feel like a dope. You know, considering all the education, all the things, and all the stuff that we look at and put in time that we put into other stuff, and this guy is just doing that? Really? So here I'm trying to simulate the same thing. Now, this isn't dummy stuff. It takes time, but if we take the market for what it is, and that's, you know, external liquidity, which is highs and lows and fair value. All the market is doing is price discovering above highs and lows and then rebalancing to fair value gaps. And it consistently does that all the time. So if that's all it's doing, that's all we need to focus on. We don't need anything else. I don't care what the order flow is saying. I don't care what the heat map is saying. I don't care what the SMA is saying. I don't care what the Bollinger Bands or the VWAP. I don't care what any of that stuff is saying. It doesn't matter to me. I know where price is going. Those lines are not going to give me any more information than what we have right here. And just by seeing how price reacts off highs and lows, and when we get to fair value gaps, that's all you need. And sorry, hold on. I am sorry. Yeah, so if all you need is fair value gaps and highs and lows, we keep it as simple as possible. Okay, and then we analyze price action on a lower time frame when price gets there, and then we wait for our buy model, which is some type of accumulation, manipulation, distribution with SMT from a 30-second chart to a 5-minute, and that's all we do. And as you can see, we just went through the 1-hour chart, okay, showing you where the direction of liquidity is. And were we wrong once? I don't think so. And if you say, well, this is all past price action, we did put it on replay. And listen, I'm getting old. I can't remember what happened yesterday. We just went back 2 weeks, and every move we called correctly exactly what was going to happen. There's no reason why you can't do that. And if you can do that, think about how easy trading will be when you know where price is drawing to. Think about that. What we just did in the beginning with the 1-hour chart. If you can do that with that accuracy, where price is going, how much easier will that make trading? Okay. Then you can add in your against the trend scalps. You know, like once you hit the draw on liquidity, you can draw away from it. Remember, right? Yeah, exactly. Do a random selection on. Yeah, you. There's no reason you guys can do what I just did. Go on replay on the hourly chart, and you can go back a few months and do exactly what I did. All we're doing is marking highs and lows and fair value gaps, and we're trying to determine price action, where price is going. That's how you practice. Don't practice by trading live market. Practice by replay. Replay is to practice. It's not for back testing. It's to practice. Back testing, we don't use replay. We just go on the chart so we can see the price action as it comes. That's back testing. Replay is practice. I'm looking for SMT everywhere, Robert. I'm looking for it on the higher time frame and the shorter time frame. I only need one, but I like both. Yeah, there's no reason to go higher. The 4 hour and the 1 hour are going to tell me the same things pretty much. I want to see the big picture first, the 4 hour. I'm just marking highs and lows. I don't care what the candles are. I'm just marking pivot highs and lows. It just gives me a wider view. It's the same on a 1 hour. If I go to a 4 hour, here's a 4 hour. The highs and lows. And now if I go down to 1 hour, they're pretty much the same. They're all the same. The 4 hour just gives me a wider view with less candles, so I can see the overall big picture. And I want to know where my 4 hour fair value gaps and my 1 hour fair value gaps, because my 1 hour fair value gaps I want to trade off of. Yeah, but there's no reason to go higher. Your daily time frame, your weekly time frame, your monthly time frame, they're not going to do anything for you. That's why all these guys that talk about top-down analysis, it's all BS. They start from the monthly, the weekly, the daily. By the time you execute a trade, your head's marbles. So are you getting stopped out, Robert, or are you entering a short? So if this was
just a rule of thumb, like on
yeah,
this one
so
right here,
if this is a 4 hour chart, I'm not automatically shorting here. I'm going down to a lower time frame to get an execution on this wick. But if this was a 1 minute chart, okay, I would short the market right there. My stop would be right above the fair value gap. These highs right above the fair value gap, and I'm targeting those lows right there. That's a one. It's only a one. This one's only a 1-to-1 risk reward because the fair value gap was so big. But typically, actually, on this one, you don't even need to go there. You can probably do it right there, that candle right there, because it should not go back into this candle, above that. And then once it starts hitting these levels, I mean, you didn't even have a chance to go break even. So that's the way I would manage that trade. But on a smaller fair value gap, I would go right below the fair value gap. Either below the candle that took the inverse did, or just below the series of bodies below it. But it's definitely a little bit below the fair value gap. Doesn't have to be that much below. Very, 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 very rarely does price wick back below the fair value gap and then continue in your direction. So get stopped out at the bottom of the fair value gap a little below. It's not a big deal. All right, I am going to end it there. I always say that people's attention span kind of drifts after 45 minutes, and we've been on for an hour and 45 minutes. But I know we've done different topics here. I have no idea what Trump talked about. I don't really see any major move in the market here. After he spoke, he started speaking around two. Continued a little higher. That's it. Here we have a data high here from this morning. That's going to get hit for sure. He talked about everything. I don't even want to hear it, Roberto. I don't even want to hear about it. I don't even know. I don't even want to know what everything is. I really don't. Good, Steve. Good. Glad to hear it. So we continue to do this. I try and mix up, the topics, each time. But for the most part, we're going to focus on, the draws on liquidity, fair value gaps, entries, targets. I think this is the most important thing that we did today. I really do. Because I always say to everybody, trade the 1 hour chart. Execute on the 30-second to the 5 minute. Trade the 1 hour. You have time. Analyze the candles, analyze the moves, mark out the highs and lows, figure out what the draw on liquidity is, and then mark out your intraday levels. And the market's going to tell you what it wants to do. If the market wants to go lower, it's going to manipulate higher first. Fact. If the market wants to go higher to liquidity, it's going to manipulate lower first, and then it's going to go higher. Okay? And when we hit any minor draws on liquidity, if we don't expand below them, chances are we're going to reverse. Yeah, Abhi, I have to cut it down a little bit because I want the session to not include the first 20 minutes of our conversation. Yeah, I'll cut it down. I'll trim it. So it might be up. I'll put the recording of this in the regular section as soon as it renders, but I will probably trim it down further for the methodology. If I can figure that out. Yes, analyze NQ, trade MNQ. Yes. Well, Rodrigo, they should be all must videos. Once you guys start really understanding concept and theory, then these sessions are just going to be more reviewing, and you're obviously going to spend more time in the active markets, demoing and keeping records. Yeah. It's just a matter of the process. I would never waste anybody's time on Tuesdays and Thursdays going over something that's not important. And I'll go over them over and over again instead of figuring out something new. It's never something new. We're always going over the same type of things. And a lot of the times, the things that I talk about are things that I see from questions and concerns that I get from you guys. That's why I did the draw on liquidity one last week. I thought that's why I did this today. I thought this was really important. I think a lot of traders struggle with this. Good, Hector. I think a lot of traders struggle with what we just went over. But if you can figure out what we just went over, like we just did, and it's not hard. We don't need any fancy indicator, but you're going to have to use your noggin. You're going to have to use your head. That's the only negative here. You got to use your brain. But once you figure this stuff out, it becomes crystal clear. And there's no indicator that's going to be able to help you here. There never was. There never is, and there never will be. Volume profile is the only indicator. It's not even an indicator. It's a tool. Order flow. It's a tool. It's not an indicator. It's a tool. That's it. All right, everybody have a wonderful evening, and we will see everybody tomorrow. You're welcome, Sebastian.
Same to you, David.
Thank
Take care,
you.
guys.
Bye-bye.